Okay, let's get started with the last part of chapter 4, where we're going to talk about the other side of the coin. So now we want to start talking about risk. Risk is the uncertainty around an investment. We can describe its volatility. A really good definition, though, is risk is the chance that the actual rate of return that you receive will be different from what you expect. And I think it makes a little bit of sense. I mean, you can expect lots of things to happen in the future, and the chance that that exact thing is actually going to happen, well, there's differences. It can be different from what you expect. The risk-return trade-off then boils down to the relationship between these two concepts. As risk increases, investors want higher rates of return. If they feel like they can't get those higher rates of returns, then they don't invest. So putting these two concepts together is a very critical component in the investment process. So when we talk about risk, what things are we talking about? Business risk. This is tied to the industry, right? The risks inherent with running a restaurant are very different than the risks that have to do with a steel mill or an accounting firm. They're different. They're related to the type of industry that we're talking about. So it relates to how management works, the kinds of assets that are purchased. Financial risk has to do with the uncertainty around borrowing. So even within a similar industry, they could have the same business risk, but they could have different total levels of risk because one company chooses to finance its operations, that is, borrow, while the other doesn't. Some other sources of risk: purchasing power risk. How does inflation affect our investment? Interest rate risk. Different companies have different sensitivities to interest rates. Banks, investment companies are very sensitive to interest rate changes. Restaurants, probably not as much. Liquidity risk. What about the ability to sell the asset? This could be tied to the company itself, but it also could be tied to the type of security that we're talking about. What about tax risks? Taxes change all the time. What's the tax code going to look like 30, 40 years from now? Nobody knows. So we have to deal with what we're dealing with today. We have to understand the concepts of how investment changes would affect today, and we just have to assume that maybe they'll be the same later on. Event risk. This is very company specific. Could bad things happen to specific companies? How do we estimate that? How do we forecast? Market risk. What happens when the economy, what happens when the stock market changes? How is that going to affect our investment or the company that we're investing in? Currency exchange. We talked a little bit about this in chapter 2. When you deal with purchasing internationally, you have to worry about currency changes. This has to do with the company's transactions as well as the investor's transactions when purchasing securities overseas. So, how do we deal with risk? How do we measure it? The standard calculation for risk is something called standard deviation. When you're looking at an individual asset, we want to measure its standard deviation. So what does standard deviation mean? Standard deviation describes how things are spread out, how the outcomes spread out. If you can imagine, you could buy an investment and you could lose $1 or you could make $4. So that distance is fairly short distance. Compare that to a similar investment where you could lose $50 or you could make $100. You can see that it's much more spread out. So the riskiness is more. Coefficient of variation is a statistic that allows us to make calculations of the relative dispersion. So how's the asset in relative terms? We want to be able to compare one thing to another. And this allows us to compare the risks of different types of returns. So here in the textbook we have two assets, right? We have the average annual rates of returns from 2005 to 2014. We also have the exact same thing for American Eagle Outfitters and obviously for Target. And you can see that the difference in return, 7.7 versus 12.4%. So how can we calculate the standard deviation of this historical data? Well, we have a spreadsheet that allows us, the historical data return spreadsheet, allows us to enter, and again, we can look at this real quick. Here's the spreadsheet. You enter the data. Now this thing, here's all the calculations that went on, right? And there's certainly some other things we can do with this data. But for our purposes right now, we really just want to look at what happens or how can we measure the risk of these two things. And if you look at, going back to the spreadsheet, you can see here what the standard deviation of Target is 21%, of American Outfitters is 51%. And the coefficient of variation, 2.7 versus 4.1. So you can see that Target has lower return, but it also has lower risk. As we'll talk about a little bit later, the correlation between these assets is also a critical factor when you think about portfolios. So in this case, the correlation between these is 0.54. Again, we'll describe that a little bit later, but I wanted to make sure we saw how that was ultimately created and calculated using a spreadsheet. You can see here the differences between returns and standard deviations. And as you go across the bar, it doesn't matter really what country you talk about, the risk-return relationship holds. Stocks are more risky than bonds and short-term government bills. So the returns are higher, the risk is higher. And that doesn't matter whether you're talking about the United States or Japan or whatever. It is true that the higher the returns, the higher the risk level. Now, what do we think about when we think about the future, right? We want to predict what's going to happen as we move forward in time. So we can calculate the expected value. What do we think this asset will be worth, or what will it return in the next 2 years or 3 years? So we can calculate the expected return or the standard deviation and coefficient variation. These are all done, except now we don't have historical data. We're going to use predicted data. So in this case, we have some predicted returns and we have some probabilities that those returns will occur. So again, without getting into a lot of detail, once you input the plugs here, said the average rate of return for A is 8.75 and for B is 3.75. The standard deviation, 8.9, 3.9, and the coefficient of variation, likewise, 1.0.91. We know how to analyze those returns. And we'll talk about what happens as we create portfolios in another section of another chapter. So if we want to assess the overall risk, if we want to look at the general risk characteristics, right, we need some basic observations, right? Risk-return trade-off exists. It's there. You can't fight it. Low risk, low returns investments, that's the way it's supposed to work. Typically, we think of these as being things like United States government securities, high risk, high return investments, things like real estate, common stock, options, futures, investing internationally. Those are the things that we think of when we think of high risk, high return investments. As a continuum, if you think about the risk-return relationship, from a risk-free asset, which would be United States government securities, as you move to higher and higher risk levels, we see that the assets, the classes of assets, typically fall into place in a risk-return relationship. Again, as a basic concept, we agree that in order to get a higher rate of return, you have to take higher levels of risk. So as a person, how does this influence you, right? What do you think as a person about the concept of risk and how it might affect you? Well, all individuals analyze risk. We look at it, but we could look at it in different ways. A person could be risk indifferent, or what's referred to as being risk neutral. This is a person that basically doesn't understand the risk-return relationship. They don't require a change in return with greater risk. Well, who would not want more return with more risk? Again, I'm not exactly sure how that fits into the logical investment criterion of a person. However, I do know that when you think about investing, frequently people search for returns. They shop for higher and higher returns, and they don't necessarily consider the impact that risk will have or could have on their ultimate portfolio. So even though it sounds kind of crazy that people won't or would never be risk indifferent, it turns out that in many situations, people do tend to chase returns and they don't think about risk. The way we think people should think about risk is with the risk-return relationship, which is an investor wants higher returns in exchange for greater risk. You want to get compensated for taking on the risk levels that certain assets and certain companies are engaged in. Risk seeking is the exact opposite. This is the person that is willing to accept lower returns for greater risk. In a nutshell, this is a description of gambling activity. People are willing to, in quotes, invest in a gambling opportunity, and if it truly is a gambling opportunity, statistically, they're actually supposed to lose money, not make money. So risk seeking talks about gambling activity. And as we can see here, this is the basic concept that we think. As a person, as risk goes up, a more risk-averse person is going to want more and more returns. Now, this is what separates us as investors, is the steepness of this slope. As you get older and older, the slope of this curve, this line, is going to increase. So a younger person might be down here, but an older person might be up here because they are more risk-averse than a younger person is. So how do we combine this? Right? When you're deciding among alternatives, you have to think about risk and return. You have to estimate what return you think you're going to receive. Then you need to assess the risk level by looking at those expectations. We need to evaluate the characteristics of each option to make sure that the return you receive is reasonable. And then in the end, you select investments that offer the highest returns associated with the level of risk you are willing to accept. In the next chapter, we're going to break this down and talk about this in a little bit more detail. That is the end of chapter 4.